Well, hey guys, this is our first ever coffee talk. We're here today to provide a little bit more financial resource to you by delving deeper into the topics of today's financial world, maybe hitting financial topics you have questions on, or just going a little bit deeper in some of the financial planning we do for clients. Uh, Many of you know us, but for those of you who don't, to my left here is Terry Connor, and I'm Christian Connor, and as you may surmise by the last name, we're a father-son financial planning duo. We own and operate Prime Capital Investment Advisors of the Ozarks, but we really want to find a way to reach out to you, provide a value add, and utilize his 31 years of financial planning knowledge and just kind of dig deeper on that. So, anything you want to add?
Well, what he's really trying to be kind is saying, my gray hair just really indicates I'm old, and I've seen a few things over that time.
Well, let's jump right in. Today's topic is what's been going around in the news, which is what's going on with the banking industry. But real quick before we jump into that, one thing I want to mention is it's coffee talk. We have coffee mugs, and I think just a fun thing to showcase is we like the peanuts in our household. So if you see these, we typically have a little bit of a fun mug going. So just for fun, a little levity, you can see what those are. But banking industry, let's give a high level overview of what has gone on and what are we seeing.
Well, we're seeing a number of questions from our clients, Christian, regarding the banking industry and is their money safe? And this was precipitated by, of course, what happened to Silicon Valley Bank. And I'm just going to try to provide really a brief and simplified overview of what happened from my perspective. Our investment team at Prime did a great job last Thursday going in depth about what's happening in the banking sector and some of the fallout from that. So I'm just going to try to give a little bit of a synopsis of that. Silicon Valley Bank was the 16th or 17th largest bank in the United States. And they had, as their name would imply, a large concentration of deposits from tech-related companies. This was not a problem. In fact, this was a great thing. Their assets had more than doubled during the pandemic. But one thing that happened that no one anticipated is that inflation remained persistently high, and the Fed began to take unprecedented steps in terms of raising rates. In fact, we've never seen rates rise as rapidly or in the magnitude as they did during 2022. And just to give people a way of thinking about that, think of interest rates on mortgages that occurred. At the beginning of 2021, they were approximately 3% for a 30-year mortgage. By the end of 2021, they were at 7%, more than doubling over a course of 1 year period. We've really never seen a magnitude of that amount in such a short period of time. Mm-hmm. Well, that caused kind of a perfect storm for banks in general, but particularly with Silicon Valley Bank. When they had those excess deposits, they wanted to do something with them. Well, with the Fed telling that rates were and inflation was likely transitory, they began to take those excess deposits from customers and invested them in government bonds, government-backed bonds and securities. Mm-hmm. Well, that wasn't a problem. If they hold the bonds to maturity, they'll get their money back plus the interest rate. However, when the tech industry began needing money because they couldn't get easy and low-funded rates on loans, they began asking the bank for their money back to fund their operations and their growth strategies. Well, this precipitated ultimately what turned out to be like It's a Wonderful Life, a run on the bank. And when Silicon Valley Bank had to start selling those securities they had, those bonds, marked now at lower prices because of the change in interest rates. Because again, a little brief history, as interest rates go up, the underlying value of bonds fall. They had to sell those bonds at losses in order to meet the demands of the shareholders, their depositors who needed their money to fund their operations. And that's what ultimately caused the bank's failure and having to be taken over by the FDIC.
Okay, so that's a great point right there. Let's stop on that one. FDIC, what is that? What does it mean? And why is it getting tossed around so much?
Well, the FDIC, as most of you probably know, stands for the Federal Depositors Insurance Corporation. They are a government-backed entity that insures deposits at banks in order to create confidence in our system. The problem with FDIC insurance is it's limited to $250,000 per individual per banking institution. So let's just give an example. You can have multiple types of accounts at a bank, but if they're in your name, for example, and they exceed $250,000, the amount above $250,000 will be deemed uninsured by the FDIC. That means that they're at risk of loss should a bank fail. And so FDIC insurance is great, and for most people, it works just fine. They don't have more than $250,000. We all need banks. We all want to keep money at banks for our daily liquidity needs when we go to the grocery store, we go to Walmart, or wherever we do our shopping.
Mm-hmm. So if you do have more money there, because obviously you can rack up a fair amount between money market savings, CDs, everything else, how do we go about then thoughtfully protecting our money?
Well, there are a number of ways we can actually do that, and we can do that easily as well. First of all, regarding FDIC insurance, as long as we don't have more than $250,000 at an individual bank, we can have it all FDIC insured. For example, one of the elegant ways we can use to help achieve this in a simplified manner is to custodian our funds at Charles Schwab. Unknown to many clients is Charles Schwab is not only a bank themselves, but they have access to hundreds of bank inventories of CDs. So as long as we keep an amount of money at any institution below $250,000, we can keep it all in one account, link it with your working account, your checking account, if you will, at the bank, and easily provide the liquidity that you need.
So we can own multiple different banks in a single account, is what you're saying, and therefore by stacking it that way, we can have full FDIC insurance for amounts greater than $250,000.
Right. We oftentimes see this with some of our business clients that for whatever reason needs to keep more than $250,000 of liquidity to run their operations. Another way that we can meet the needs of our clients and keep their money safe is to use U.S. Treasuries. U.S. Treasuries are backed by the full faith and credit of the U.S. government and are considered the safest investment in the world right now. Those rates from 3 months to 1 year and even longer are north of 4% right now. We mentioned earlier CDs. CD rates from 3 months to almost 5 years now are north of 5% currently. So we can get substantially better yields right now in those investment products than most banks are offering. The average rate that banks are offering right now for checking and savings account is about 0.35%. So substantially under a 0.5% return with little or no effort, we can get north of 4% easily in a safe, guaranteed investment.
I think that's a great point to make here real quick, is that you don't have to take a lot of risk right now to earn a decent return. These unprecedented times, while frustrating in many respects, still give us opportunities, and we can pivot with those opportunities to meet client needs. So
yeah, I think we can easily offer guaranteed type products with rates north of 4% currently.
I think it's good because most people don't know we can do that. We have all that availability at Schwab and our ability to get significantly better rates because we can shop the country, so to speak, rather than just our individual banks.
That's right. Trying to run around and find the best rates across the country or even here in town is a lot of time and effort. So we can simplify that process, and because we are shopping rates across the country, typically we're going to have top tier rates to offer to our clients that are extremely competitive, as evidenced by the rates we've talked about already.
Okay, so I know we developed this example together, but just to run through it, let's go for an exorbitant amount. Let's say you had $2 million of cash on hand. You're a big business, you need to really protect it, or maybe for some reason you're an individual that has large deposits at the bank. What is a way we could structure it? Because obviously you're not going to need all $2 million at once. So is there a way we could structure this to make the longer term return look better?
Absolutely. Again, going back to if the average bank account is yielding 0.35% right now, and we're talking about returns north of 4% easily at this point in time, That's a substantial increase on our yield, and that's just more dollars that flow to the bottom line. So let's take the example of $2 million, and this is just one way we could do this. There are multiple ways. We could use all CDs, for example, and we could buy multiple CDs under $250,000 per institution and ladder them over a period of, let's say, a year. Let's take $1 million of it. $1 million, we could buy 4 CDs, $250,000 for each maturity of 3-month, 6-month, 9-month, and a year. Get north of 5% on all of those yields currently. So every 3 months, we would have $250,000 in my example coming due to provide excess liquidity. Maybe we took another $500,000. If we didn't want to buy just more CDs at those levels, we could buy U.S. Treasuries. We could do the same thing. We could ladder a 3, a 6, a 9-month, and a 1-year Treasury at rates north of 4% right now. And if we needed even more daily liquidity, we could say take the remaining $500,000 in our example and buy the Schwab U.S. Treasury Fund. The Schwab U.S. Treasury Fund, as the name implies, buys short-term U.S. Treasuries, again, backed by the full faith and credit of the U.S. government. We could provide all the liquidity we could reasonably need with extremely safe, oftentimes guaranteed in terms of the U.S. Treasury as far as the full faith and credit and the FDIC insurance of the CDs, and provide a yield north of 4%, which is about 3.5% better than the average yield in the savings accounts at banks right now.
Well, guys, that wraps up our coffee talk for today. We hope you found this information helpful. If you have any questions about your own cash deposits or how this could fit into your own financial planning, please feel free to reach out to either myself, Dad, or Colin, our other advisor in the office. We'd love to be able to help you with your financial planning needs.
As always, we're fiduciaries and looking out for your best interest. We're financial planners at heart. We believe that having a good financial plan drives our decision making when our emotions cannot. We look forward to hearing from you.